Hey everyone, welcome back to Corporate Decoder. Today, BNY just filed their second quarter 2026 Form 10Q, and I'm seeing some interesting shifts in their balance sheet. Quick note, this is not financial advice, just my take on public filings for educational purposes. While their assets under custody are soaring, their profitability metrics show a mixed bag, and I am keeping an eye on how they navigate interest rate changes. So, we are diving into the latest financial report from the Bank of New York Mellon Corporation, ticker BNY, for the quarter ending the 30th of June 2026. Let's jump straight into the numbers. For the second quarter of 2026, BNY reported net income applicable to common shareholders of $1.7 billion. That is up from $1.4 billion in the same quarter last year. Diluted earnings per S-share came in at $2.45, up from $1.93 a year ago. Fee and other revenue showed a solid increase, reaching $4.3 billion, up 11% from the second quarter of 2025. This strong performance was mainly driven by investment services fees, which climbed 13%, and investment management and performance fees up 5%. Fee revenue as a percentage of total revenue remained high at 71%, showing that BNY continues to rely heavily on its fee-based businesses. Assets under custody and or administration, or AUC buyer, hit a massive $62.6 trillion at the end of June 2026. That is a 12% jump from a year earlier, thanks to higher market values and more clients bringing their assets. However, a stronger US dollar did put a slight dent in that growth. Then there are assets under management, or IAM, which reached $2.2 trillion, a 6% increase from the previous year. This growth was also helped by higher market values, but again, the stronger dollar and some client outflows slightly tempered the gains. Now, let's look at net interest income. This climbed 20% to $1.4 billion compared to the second quarter of 2025. The company benefited from reinvesting its investment securities at higher yields and overall balance sheet growth. However, they did note some deposit margin compression, meaning they are paying more to hold onto those deposits, which ate into profits a bit. The net interest margin, a key measure of profitability on lending, was 1.45%, up from 1.27% a year ago. On average, their interest earning assets grew by 6% compared to the previous year, reaching nearly $398 billion. This includes a notable increase in loans and investment securities. When it comes to expenses, non-interest expense went up 7% to $3.4 billion. This rise was mainly due to higher costs associated with the increased revenue, investments in the business, and employee salary increases. They did mention some efficiency savings, but those weren't enough to fully offset the higher costs. Looking at segment profitability, the securities services segment showed a strong 28% increase in income before taxes, reaching over $1.1 billion. This was driven by higher revenue and a pickup in client activity. The market and wealth services segment also saw healthy growth, with income before taxes up 21% to $1.02 billion. This was powered by higher net interest income and increased clearance volumes. However, the investment and wealth management segment saw a more modest 23% increase in income before taxes, reaching $182 million. While still a gain, it suggests this segment might be facing tougher market conditions or slower growth compared to the others. Now let's touch on goodwill. BNY has $16.7 billion in net goodwill as of June 2026. Importantly, they performed an interim goodwill impairment test for their investment management reporting unit and found that its fair value exceeded its carrying value by about 6%. This means no major write-downs were needed, which is good news. Moving to loans, total lending related exposure was nearly $139 billion, up 6% from the end of 2025. A big chunk of this is in margin loans totaling over $30 billion, which are fully collateralized. The allowance for credit losses, which is basically a reserve for potential loan defaults, actually decreased slightly to $339 million from $379 million at the end of last year. This reflects improvements in their commercial real estate exposure, which is a positive sign. Their non-performing assets also saw a significant drop down to $33 million from $143 million at the end of 2025. This is largely due to a decrease in non-performing commercial real estate loans, which is definitely a good trend to see. Let's look at their capital ratios. The Common Equity Tier 1, or CET1 ratio, under the standardized approach was 11.0% at the 30th of June 2026. This is down slightly from 11.9% at the end of 2025. They attribute this primarily to capital return to shareholders through buybacks and dividends and an increase in risk. weighted assets. Their liquidity coverage ratio, or LCR, remains strong at 111% on average, indicating they have enough high-quality liquid assets to cover outflows under a stress scenario. They also maintained a healthy net stable funding ratio, or NSFR, at 130%. When it comes to trading risk, their value at risk, or VAR, gives us a glimpse into potential losses. For the second quarter of 2026, the overall portfolio VAR averaged $2.9 million. This measure looks at potential losses over one day with a 99% confidence level. While this seems small, remember it is just one tool and doesn't capture every possible risk. Looking at daily trading revenue, most days saw gains between $0 and $5 million. Interestingly, they had 23 days with revenue over $5 million in the second quarter of 2026, which is down from 32 days in the first quarter. This suggests a slight cooling off in trading profitability from the previous period. On the liquidity front, their total consolidated high-quality liquid assets, or HQLA, stood at $251 billion. This is a solid number, reinforcing their ability to meet obligations even in tough times. Now, about interest rate risk, BNY provided a sensitivity analysis. If rates were to shock up by 200 basis points, they estimate net interest income could decrease by $110 million. Conversely, a 200 basis point drop could reduce it by $247 million. This shows they are exposed to rate changes. But the impact seems more balanced than in previous periods thanks to adjustments in their balance sheet and hedging strategies. Overall, their balance sheet grew to $525 billion at the 30th of June 2026, up from $472 billion at the end of 2025. This expansion was largely due to increases in deposits, loans, and investment securities. Shareholders' equity remained strong, ending at $44.7 billion. This increase was driven by earnings, though partly offset by the capital returned to shareholders through stock repurchases and dividends. Their Common Equity Tier 1, or CET1 capital, stood at $21.6 billion. This is a critical measure of their core capital strength. And looking at the top line, total revenue for the quarter was $5.7 billion, up 13% year-over-year. This growth across their business segments is a good sign of overall business health. So, what is the takeaway? BNY is continuing to grow its assets under custody and management significantly. Their fee-based income remains strong, and their capital and liquidity positions appear robust. However, they are facing some margin compression on deposits and need to carefully manage their interest rate sensitivity. The slight dip in CET1 ratio due to shareholder returns is expected, but they remain well above regulatory minimums. The company is navigating a complex environment, and its ability to manage these intertwined financial levers will be key. What I am most interested in seeing is how their continued focus on fee-generating services will hold up against the backdrop of evolving market and interest rate dynamics. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.